What's your current assessment of the global economy and financial markets?
Well, let's start with the economy. I think the economy is staying pretty resilient considering that the Fed has raised rates as much as they have. And you have other central banks around the world, ex-Japan, that have also raised rates. What's puzzling to me is that the markets are trying to play, as Neil Kashkari said, a game of chicken with the Fed, and they're not necessarily believing the Fed that they're going to continue to raise rates. I think that is ill-advised. We've seen some downticks on economic reports. We've seen downticks with earnings. I still think that earnings estimates are too high for 2023, and there's going to be some more economic pain ahead, notably in unemployment rising, and we're at 3.4%. And to think that the market is being bid up, believing that the Fed's about ready to cut rates later in the year is a little absurd to me.
Is the current rally warranted? Right? Is the bottom? Have we seen the bottom in 2022? I assume because you're saying there's sort of an absurd disconnect right now between market sentiment and what the macro data is showing. Maybe you don't believe so, but I don't want to put words in your mouth.
If inflation doesn't come down enough and fast enough, it's already started to drop. You see the CPI data has started to decrease, and that's really positive. But we were coming from such a high level that I don't see it dropping in the same magnitude. That's a risk, high probability risk. The other bigger risk is if inflation starts to tick up again. And I can say that you can look at energy right now has been just hit so hard. And I think that you've had a lot of the bulls be very, very frustrated with, especially with crude, because they are looking at over the horizon saying that the SPR is going to have to get refilled eventually. And that someone mentioned once that it was like Joe Biden's going to walk into the Chicago oil pits with a sticker on his forehead saying, I need to buy, a few hundred million barrels of oil, and the price would spike higher. And then China reopening was supposed to also be positive for crude, and that's really not materializing. I still think China's reopening is going to be a stage type situation, and that will take time. I think natural gas is oversold, and I'm currently long a little natural gas. I think crude could bounce from here as well, but I don't have a high conviction call on that. So there's a lot of stuff that's happening this quarter that could be very positive.
To me, it seems that Powell really is still committed to demand destruction, but he's feeling like we're going to start seeing a lot more demand destruction. He kept talking about disinflation. I think he mentioned it like 15 times. His tractor beam that he's intentionally trying to affect there on prices is working. And he's basically saying, again, you ain't seen nothing yet because everything I did is just beginning to hit now.
Yeah, the market didn't really pay much attention to that line.
Yeah, at all. So I guess my question for you is, and maybe I'll tie this to one of my other trend questions, but sort of, the risk of recession and the risk of a harder landing than this magical soft landing everybody seems to be, expecting right now. Do you think on the demand side, would you take the over or the under, I guess, since you're having to bet in your portfolio, which bet are you taking here?
I just want to mention one thing first, that financial conditions index, you can look at a bunch of different metrics. They're high. Well, actually, it's looser than before the Fed started to raise rates.
Before the first rate hike. Yeah, exactly.
Yeah, that to me is pretty astounding. And I think as far as rate hikes, I think there is a bit of a thinking within the Fed that they may be downshifting to 25 basis point hikes for longer. They want to postpone the whole thought of we're about ready to start cutting rates again. I think that is really important. I don't think that they're going to cut rates unless the market has some dislocation. There's some geopolitical problem in the world. Hopefully not.
Some credit event or something like that, right?
Yeah, and
that's not bullish, right? I mean, that wouldn't be for reasons that would be bullish for stocks, right?
Well, I think, oh, look, if we start to see credit events, and credit's been pretty resilient for the whole year, we haven't really seen a lot of things that have happened in the past that we typically would see. I mean, I'll get to the over under on that in a second, but for people to think that at 3.5% or 3.4% unemployment, when you continue to see the jobs unemployment claims coming in under 200,000 per week, I think is really hard to swallow for me. I know that they have done a pretty good job on the non-sticky type of inflation, the transitory inflation stuff. Airline fares have come down a little. They may go back up. I just booked a couple flights and was a little bit taken back. You're seeing today, we saw that the used car Manheim index ticked up 2.5%. It's the first uptick since 2020. And I think the Fed could be stalling out the future rate cuts by continuing 25 basis points.
If you think demand is going to be lower than the market's currently pricing in, I guess how bad, right? In other words, do we have a recession this year? Do we have a hard landing, or at least err on the side of harder versus softer?
Okay. A lot of people want to they want to go the soft landing, hard landing, recession, no recession. Well, one of the things that typically happens after you have these boom bust cycles is it takes a lot longer than 1 year during a bust cycle. And there are a lot of things that I haven't seen that say, hey, we're going to be in a recession, partly because we haven't seen unemployment tick up. And that when that happens, that'll increase my belief that we will be in a recession. If the Fed starts cutting rates, they're doing QT. They're trying to reduce their balance sheet. So that would sort of go against two policies working against each other. So I don't see that. I don't see rate cuts coming. But if, let's just say, they stop QT and they start cutting rates, the economy could still be in a downturn, and the markets could still be suffering through more dislocations, even weaker earnings. Look, if unemployment goes up, then you're going to have a problem with a lot of different asset classes. You see consumer staples and discretionary start to weaken, car sales weaken, housing weakens. So that's kind of my view on the inflationary type of situation of what to expect. Let's not get too far ahead of ourselves and make big, predictions that I know the little steps that I want to see to be correct or wrong, and that's how I look at things. I don't want to go too far ahead and say,
Got it. You look at it more sort of incrementally. Yeah.
And I think that's the better way in this environment.